It's an ancient story. Zeus locked away fire, and Prometheus stole it back, handing the flame to everyone. Fire heats, but it also burns. Similarly with progress, it never arrives alone. It brings both risk and opportunity. Yes, Prometheus brought fire back to humanity, transforming risk into opportunity through careful application. In 2008, Bitcoin emerged as finance's modern-day spark, an experiment that has now matured into an institutional asset class. 16 years later, for defensive investors, the question isn't whether crypto belongs in a portfolio, but rather how much. Innovation and risk always arrive together. Discipline is the hearth where we transform that heat into practical and useful benefits. Bitcoin, Ethereum, gold, and stocks are all flirting with or making new all-time highs. Only bonds continue to lag. With clearer US rules and stablecoins as a functional killer app, digital assets look less like a curiosity and more like the new financial rails. Now, skepticism is always healthy, but we have to be honest. The question has now shifted from if to how much. Still, opting out is reasonable. No asset is mandatory, but I rarely recommend a 0% allocation. Our earlier work, called the 5% solution, demonstrated how a 2.5% to 5% crypto slice could improve a stock-bond mix. And today we have another illustration, not a recommendation, just an illustration. In it, we model what we call the Prometheus Portfolio, which is 45% equities, 40% bonds, and then 5% each in gold, Bitcoin, and Ethereum. And the key detail here is that we rebalance that mix quarterly. That process actually harvests the volatility that Bitcoin and Ethereum are so famous for. What about results? Well, against a traditional 60-40 mix, the Prometheus portfolio roughly doubled compounded returns over 7 years. It generated 20.61% versus 9.5%, with a modestly larger maximum drawdown. It's the engine of rebalancing that really brings the value here. What we're effectively doing is harvesting volatility on a quarterly cycle. And look, I know that volatility is what scares people. Fair enough. But when a small position is rebalanced quarterly, that very volatility becomes a source of return. We're basically selling strength and adding weakness without betting the farm. So here's 3 takeaways. Number 1, Bitcoin and Ethereum have gone mainstream as policy and infrastructure improve. Number 2, a modest slice can enhance outcomes next to 60-40, and remember, the sizing beats timing. Number 3, embrace the volatility, but on your terms. Keep the position small enough to sleep at night and let the rules of rebalancing do the work for you. Look, if this resonates, here's what you should do. Download our free ebook to learn more. Then reach out and we'll review your plan and decide together whether a 2 to 5% allocation or none at all fits your goals. I'm Glenn Evans from Evans Family Wealth. We're here to help.